using examples of real companies and stock symbols and stock prices. Please do not take that as thinking that I'm recommending those stocks for you to buy or sell now. I'm not. I'm using them as examples. So before you start investing, because all investing carries risk, you should really talk to a financial advisor or perhaps your accountant or anybody who is familiar with your situation. Again, nothing today should be taken as personalized investment advice for you because I don't know your situation and we do not have an agreement that I am providing you financial advice. All right, that's out of the way. Now to the fun stuff. All right. So I made my first stock trade at age 24 using a $1,600 inheritance. And as you can see, by the time I turned 40, I was a millionaire. All right, how the heck did this happen? Well, let me tell you. So I graduated from college in 1990 with a finance degree from the Wharton School of Business at the University of Pennsylvania. And I actually, since 1990 was a recession, I remember I was employed by my first job for 3 months, got laid off, got rehired because my peer was leaving the company, so they rehired me. Then I left them to find a more stable job because I was irritated that they had laid me off. And then I worked at another company for about a year and I got laid off. 4 years old, I'd already been laid off twice. I lived in a very tiny studio apartment in Washington, D.C., roaches everywhere. I took showers with roaches. The trash dumpster noise was just ridiculous. I mean, I think even on Saturday mornings, I couldn't sleep in because I'd hear that. I had student loans, right? 10 years of student loans coming in front of me. I was already paying them. And anyway, it was a real bummer. So when I got, in 1992, I got this inheritance, the $1,600 inheritance from my grandmother, who was clearly not a wealthy woman, even though $1,600 might have been worth a lot more in 1992 than it is today. It wasn't worth that much more. Now, of course, any other 24-year-old woman would agree, you were all 24, unless you're not 24 yet, you would agree that if you got $1,600, you'd probably want to spend it on what I wanted to spend it on, which was clothes and shoes. All right, well, maybe you want to spend it on other things, but I think there's a good chance that maybe you'd want to spend some of that on clothes and shoes. I really did want to spend it on clothes and shoes, but I knew that I needed to do something to use that money to really that I could grow and count on for financial security, because I knew I couldn't trust an employer to take care of me. It wasn't stable. And thank goodness I already had another job and I wasn't laid off, for years, because I had a very successful career. And if I had still been laid off, I probably would not have invested the money. But I was newly employed and I bought 40 shares of Starbucks stock, and it was trading, I remember, at $39.75 a share. I bought it. I opened a brokerage account at TD Ameritrade. It's called that now. It wasn't called that then, but it's TD Ameritrade now. And in those days, there was no internet, ladies, remember? And so you could actually, for 30 bucks a trade, you could punch in on the touch-tone keypad, bing, 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 your stock trade. And I got the Wall Street Journal and I would check out the stock. And of course, Starbucks, the stock over time went up, it went down, it went up, went down. That's what stocks do. And it was just so empowering to see that some days it went down, some days it went up, but more often than not, it was growing over time. You can remember Starbucks back then. And so I started, how did I become a millionaire before I turned 40? Well, I started anytime I got a windfall. I didn't spend it. I lived within my means of my salary. Anytime I got a windfall, whether it was a tax refund or a $50 birthday check from my great aunt, I would invest in the stock market. I'd buy different stocks, new stocks, more stocks. So I'd be diversified. I mean, before I knew it, I had like hundreds of individual stocks, and then I would buy and sell, and it was unbelievable. And I wrote a whole book about it. It's called Every Woman Should Know Her Options, Invest Your Way to Financial Empowerment. And, since a lot of the women are going to be talking about real estate today, I had the opportunity that I could have bought a condo in my 30s, but the thought of having to take out tens of thousands, even maybe $100,000 out of my stock brokerage account to buy real estate, that meant I'd have less capital to buy and sell stocks. So I didn't want to do that. The $1 million was a combination of my taxable brokerage account as well as retirement accounts at work. I mean, I always tell you, if you have a 401k at work, max it out if you can. I really tried to max it out. And, you'll find if you have a diversified stock portfolio, the 401k was tax deferred, and you're going to grow your money if you're smart, if you don't panic, if you're diversified. So that's my story. Oh, and by the way, let me go back here. By the way, the book, when I published it, it became an Amazon bestseller in 3 categories. So I'm really, there's lots of reviews online on Amazon, on Goodreads, and I'm just so thrilled that so many people all over the world, in fact, and men too, men read it. So many people have benefited from it. I'm just honored. It was such a wonderful project, and I'm so honored to help so many people. Okay, let's look at stock market investing for income. Okay, now whether you're a beginner to the stock market or you're experienced, I know you're going to get something out of this presentation. So look, the pros of stock market investing is you have no tenants, no toilets, no trash. I mean, I can't even think about being a landlord. I've got enough problems. The last thing I want to do is have someone call me up with another problem. I have to manage my own life. I don't want to deal with that. I mean, I don't want to deal with that. And then I don't want to hire a property manager to deal with it. So no tenants, no toilets, no trash. Hooray. It's easy to diversify in the stock market. With a click of the mouse, you can buy, from hundreds, thousands of individual stocks, not in the US, even all over the world. There are mutual funds. There's now exchange traded funds, ETFs for short, that weren't available when I started investing. So you can spread your risk over companies, size of companies, industries, sectors, geographic regions. Really, you can invest in real estate through the stock market. You can invest in gold through the stock market. So just think of the universe through a brokerage account or a retirement account, such as an IRA, an individual retirement account. So the third point here, the biggie, instant liquidity. If you need your money, click of the mouse, you sell something, and within 2 days, that cash is yours to take out. Boom, ACH transfer, or you can wire it, whatever you want. Try to move real estate quickly in 2 days. Come on. So the liquidity risk is so much lower here in the stock market. Okay, what are the cons? Stocks are volatile. Hey, 2020, we had a crash. We had a crash in 2007 to 2009. Stocks don't just go up in a straight line, right? They go up and down. There's volatility. Some people don't like that. I actually like the volatility because if you are patient and when the stock market is down, it's usually a good buying opportunity. Now, if you don't use options, your income is limited to dividends, okay? And generally, but not always, most stocks pay dividends every quarter, every 3 months. Not all of them. Some exchange traded funds, ETFs, pay dividends as well. But not all stocks pay dividends. So if your portfolio is comprised of Amazon, Tesla, Facebook, you're not getting any dividends. You get no income. Your money's just sitting there hoping the stocks appreciate in price. They could also depreciate in price. So there are many stocks that pay dividends and many stocks that do not. Okay, so now I hope you can see this all. This is, let me walk through this. Now we're going to have a couple of slides that are pretty intense. So this here is a chart over many years from about 2003 to the present. And I'm using the equal weighted S&P 500 index. What does that mean? When you hear like on the radio, well, the stock market fell blah, 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 2% today or blah, they're either talking about the Dow Jones Industrial Average or the S&P 500. When they're talking about the S&P 500, all they mean is that this is a basket of stocks. It's an index that is comprised of the 500 most capitalized companies, publicly traded companies in the US. So what's in the S&P 500? Names you've heard of: Apple, Facebook, Google, Amazon, Starbucks, Chevron, anything really you can think of, Pfizer. I mean, just really lots of companies you would recognize, Coca-Cola. Now, I like to use the equal weighted S&P 500 because I know this is getting technical, but basically with this index, every stock, every company has equal weight. So if I have a pie and I want diversification, I have 500 slices of that pie, and each company is responsible for a slice of the pie. Whereas the S&P 500, much of the price movement is driven by just a handful of stocks because they are the most capitalized. So right now, if Apple goes up or down a lot in a day, the S&P 500 may move significantly too, whereas the equal weighted will not move much because of all 500 people, they all have an equal vote. In the S&P 500, certain companies have more votes than the others. That's the best analogy. Okay, so let's look at this chart. You can buy this. So there's an ETF, again, I'm not recommending you buy it, but there's an ETF called RSP. That's one of them, which is you can buy shares in that, and you're going to be invested in a mirror of this. So if you had invested in the RSP in 2003, you'd see you're going up, up, up. I mean, look at the price. I need to put my reading glasses on, but you basically see this index. We were at 30,000 back in 2003, and now we're at, we were at 30, excuse me, and now we're at 111. I'm recording this on I made the slides last week, so the slides were done in August. So anyway, the point is, you can see it went from about 30 here to now 100. Okay, it's gone up a lot, but on the way up, 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 huge bull market. 2007, that was the big crash. Boom, that was like the worst crash in our lifetime. And then a huge 12-year bull market, although there's ups and downs. So if you're holding stocks here, if you buy stocks on this day, a few weeks later, you're like, ugh. But if you stay in, high, a low, boom, boom. This is the Christmas Eve crash of 2018. And here's the huge coronavirus crash of February 2020, between February and March. Look how steep. But if you had sold everything here, if you had panicked, you would have missed this huge rebound. Okay, so the point is, stock prices are going up and down every day, but over time, if you have a long enough time horizon, you're probably going to grow your money if you're properly diversified, no different than real estate. Okay, now let's talk about some income. The current annual dividend yield of this index is approximately 2%. So remember, I said, before I turned 40, I had $1 million. If I had invested that entire $1 million in this index or a fund that mirrors this index, I could presume that I would probably generate $20,000 a year in dividend income. If this was in an IRA, I don't pay tax on any of the dividend income. If it is a brokerage account, I am going to pay tax on the dividend income. If you live in a state with no income tax, lucky you, I live in California, so I have a very high state income tax. But dividend income at the federal level is taxed generally at a lower rate than the money you earn when you're working, or that you might earn from bond interest, okay? If you're in a high tax bracket or even a modest tax bracket, dividend income is probably going to be taxed lower than if you went out and you worked for that money. Okay, so if I have $1 million and I'm generating $20,000 a year, fine, maybe that can supplement my income, but I can't live on $20,000 a year. So not so good. But if I come down here, by overlaying a covered call strategy that I'm teaching you today, you can generate, and put a range here, between 30 and 80,000 in annual income. It will be taxed at a short-term capital gains rate, so you'll pay more tax on this income than you would on the dividend income. But again, I'm a financial advisor. I manage many people's portfolios, and we work together with their tax advisor to optimize how much they pay in taxes to mitigate where we can. So you can see, if you're just the regular investor collecting your dividend, which is what probably 99% of your friends and family do if they invest in the stock market, you know, you're going to generate a 2% yield on this. Now, some stocks, individual stocks like AT&T right now is generating about a 6% yield. You can expect, no matter what happens to the stock price. So let me explain this. No matter what happens to the stock price, it goes up or down, as long as it can maintain paying its shareholders that dividend, you'll get that income. Now, I like investing in stocks that have increased their dividends over time. There are certain companies that actually increased their dividend even in the 2008 recession. And there are companies in 2000 that have cut their dividend, probably because of the recession and coronavirus. So where was I going with this? But if you're doing a covered call strategy, you can potentially collect the dividend and you can generate much more income. All right. And why is there such a big range, 30 to 80,000? Because, and it's not literally 30 to 80,000. I'm putting what a range would be, or an estimated range. It's because you control how much risk you take. You and this strategy determine how much income you're going to generate and how much risk you're willing to take to generate that income. All right. And you should know that when stock prices go down, if you're generating income on a regular basis, it provides an offset or a cushion, right? Just think, if you're renting out real estate, the real estate value may fluctuate, but as long as those renters are paying you the same amount of rent, you don't really care until you sell the property, right? You hope it's gone up in value when you sell the property. Same thing with the stocks, but covered call overlay is helping you generate income, and for that you give up some upside. You give up some upside. I'll explain in the next slide. Okay. So just to summarize this, and I'm trying to move my head. Where can I move my head? Here we go. Look, I always say, instead of renting out a property for income, why not rent out your stocks? Okay, again, you can do this in an IRA. You can do this with retirement money, and you don't need a self-directed IRA. You can do this at any brokerage account that has an IRA. Okay, so look at this light bulb. That was the light bulb that went off in my brain when I attended a seminar years ago that TD Ameritrade had put on. And I'm like, well, yeah, I've been investing in stocks for a long time. It's great. Yeah. I buy and I sell and I earn dividends. Well, when they told me that I could, get this, stay with me here, I can buy stock, right? Then I can agree to sell that stock at a higher price in the future, and I will get income today. I will get option premium today. So let me repeat this. I can buy 100 shares of stock, right? Here's a covered call. I can buy 100 shares of stock in a company or ETF. Not all ETFs have options on them, but many do. So I'm going to buy 100 shares of stock, just like I normally would. Then I'm going to agree to sell that stock at a higher price in the future. And because I agree to do that, I get income today. How much income? That's going to depend on a lot of factors. But can you believe this? I mean, the light bulb went off my head, because I'm thinking, gosh, if my stock goes up, 10% or 20% in a certain time period, I'm going to be selling that sucker anyway, because, if it's already gone up 10 or 20%, does it really have more growth to go that rapidly? Maybe I should sell, redeploy my capital somewhere else. So this was fantastic. I could get paid today to agree to sell my stock at a higher price in the future, which I would do anyway without getting paid. Gosh. All right. Covered call. You buy 100 shares of stock in a company or ETF, and then you sell one call option for income. It's called option premium or call option premium. Can be used in a taxable brokerage account or IRA. This is so fabulous. And yes, there is a downside, and we'll get to that. Well, I'll just tell you the downside right now. The downside right now is if I really think I'm a really good stock picker and every stock I pick goes up 20 or 30%, well, then I don't want to use a covered call strategy. But come on, people, how often does that happen? I might buy a stock and it's sort of flat, doesn't really grow. I might own it for a year or two and maybe it's gone up 2%. Maybe it's gone down 3%. Or maybe, they don't all go up. They don't all go up at the time within the time frame that you want them to go up. Otherwise, you'd hear people making 30% annual returns in the stock market consistently. That cannot happen consistently. So what I am doing in exchange for guaranteed income today, it's guaranteed when I sell that call option. In exchange for guaranteed income today, I give up some upside. So what if I agree to sell the stock at 10% higher price or a 5% higher price? If that stock goes up 20%, I didn't capture the 20%. I still captured the 5 or 10%. I knew when I made that deal how much my max gain would be on the stock. And I knew when I made that deal how much income I would get today, right? And I knew when I made that deal how much the stock could drop in price before I was hurt. I like this. It's like a three-dimensional thing here, game. Well, it's real money, but it just takes, it's an overlay of sophistication to something that many Americans already invest in the stock market. Well, many people all over the world invest in stocks. All right. Whoa. I've heard options are risky. Whoa. Well, options can be risky when they're used to speculate on big price movements, either up or down. So when you buy a call option, you are betting that stock is going to go up. Usually it's going to go up a lot very quickly, all right? Like within a matter of months, depending on your expiration. And same thing when you buy a put option, you're thinking a stock's overvalued and it's going to fall in price. These are very speculative strategies. I do not recommend them. I rarely engage in them. So for my own personal money, and I do not do them with my clients' money because I would not buy a call or put option by itself, because although you can use leverage, you can use a little bit of money to control you invest a little bit of money and you can make a great return if the stock price moves. But and there's many advanced option strategies that that there's many. So I'm giving you the simplified, call and put 101. Okay, but you can lose all your investment, right? But that's why I don't like it. But with covered calls, you already own the stock, and then you're selling a call option. You're not buying the call option. You already own the stock, which is sort of like your collateral. You're selling a call option. It is here's the deal. Buying the stock and owning the stock and selling a call option on top of it is less risky than just buying the stock by itself. Think about that. The call option, when combined with owning the stock, is less risky than owning the stock by itself. Light bulb. Okay, now I warn you, these two slides are going to be very busy and this is very technical and I'm not going to spend too much time on this. You can watch this presentation again and really study it. But let me give you an example. Now I'm showing you this platform. It's an online platform called Born to Sell. And so I took this screenshot on, as you can see, August 13th. And StarBucks pays a quarterly dividend of 41 cents per share. You can look that up on Google. All right, that means that if you own 1 share of Starbucks, you should expect to receive 41 cents 4 times a year, okay? Now, Starbucks, when I took the screenshot, a share of Starbucks was going for $78.64. So how do I know what my annual dividend yield is? I simply take the 41 cents times 4 equals $1.64 share in dividend income a year. I divide $1.64 by the share price, and I see that Starbucks is yielding 2.1%. What does that mean? That means if I own Starbucks, and they're a pretty reliable dividend payer, if I own Starbucks, I can care less if the price goes up or down, if I don't need the money in the near future, right? If this is long-term investment, and I'm just collecting my dividend. So a savings account right now isn't even paying you 2.1%. So dividends, that's one of the reasons why, people like the stock market when interest rates are low, because they can get more income from a dividend, which is taxed at a lower rate than the interest you earn in the savings account or a CD. Now, so back to Starbucks. So think about this. So what if I want, though, I don't really okay, let me back this up. I have many clients, particularly women after divorce, who have a settlement and they're trying to live off their settlement money, right? They may have a portfolio of $500,000, may have a portfolio of $1 million. And we are trying to generate income that they can withdraw every month to help pay their bills without selling off the principal, okay? Sometimes we have to sell the principal. Sometimes the principal goes up in value. Now, what's great about dividends is that if you are holding it long term and the stock price goes down, you can choose to have your dividend reinvested into buying new shares if you don't need the income. The dividend just buys shares at lower prices, and then over time you have more shares than you started with. That's called dividend reinvestment. Now, let me show you what this is. When you start trading options, you're gonna have to become familiar with what's called an option chain. I'm not gonna show you that here. This is a platform that he sort of throws the option chain into a better user interface. And so in this case, I took the screenshot on August 13th. Starbucks was trading at $78 a share. I can buy 100 shares. And if I buy 100 shares, it's going to be an investment of $7,864. Now, this was August 13th. If I sell an October call option, which expires about 2 months from when I took this screenshot, that option expires, let's call it 2 months. I can buy the stock, and sell a call option with an $80 strike price. What does that mean? It means that I bought the stock today for $78.64, and I'm agreeing to sell it in the future for $80. Now you're thinking, well, wait, Laurie, that seems stupid. Why would you only make, $1.34, or on 100 shares, you'd make $1, I'm sorry, my math, you would make $136 profit. Well, if I sell a call option, though, guess what's happening? They're paying me $281. See this call bid? The option buyer is paying me $281 today to agree to sell stock that I'm going to pay $78.64 for $80 2 months from now. Okay? So in this case, I don't really need Starbucks to go up much in value, all right, in 2 months. But I'm getting that call option premium, which I can count on because I'm getting it today. Now, let's do another example. Let's say I'm really afraid that Starbucks could go down or the market will go down. I can agree to sell a call option at 75 that's lower than what I paid for it today. Now, why would I do that? Why would I agree to sell stock that I bought for $78.64 for less, for $75 in the future? Well, because I'm getting paid option premium of $570 today, right? This is all in 100 share units. I buy 100 shares of Starbucks my investment is $7,864. I get $570 today to agree to sell it in the future at a lower price. But selling it at a lower price is going to be less of a delta than what I got paid for the call option premium. And you know what that translates into? That translates into risk mitigation. What did I say? It translates into risk mitigation or downside protection. 7.2%. That Starbucks could fall as much as 7.2% between now and 2 months from now, and I'm whole. I only lose money if that stock falls by more than 7.2%. And if it stays flat, let's just say it stays at 78, or it goes up. It stays at 78 or it even goes up. My return in 2 months is 2.8%. On an annualized basis, that's 16.8% a year. How is this right? I'm getting income today. I may collect the dividend, but I don't even count on the dividend. The dividend's small compared to the option premium. I'm agreeing to sell my stock at either a higher price in the future or a lower price in the future. I choose. The amount of income I get in terms of call option premium is going to be dependent on if I sell it at a higher price, agree to sell it at a higher price or a lower price, okay? And I get downside protection. If I want Starbucks to grow, if I'm buying it because I think it's a long, I think it can go up, then maybe I'll choose the 82.5 strike price. What is my downside? There's no free lunch. What am I giving up by doing this? Well, I'm giving up upside, lots of upside. If I've agreed to sell Starbucks 2 months from now at 80, if it trades at 81, I have to sell it at 80. If it trades at 90, I have to sell it at 80. But how often does every stock I buy shoot up in a couple of months? Not very often. Okay? All right, we're going to do one more example. Now, just so we remember, Starbucks, if you just get the dividend, you can expect 2.1% a year. Now here, MetLife, we did MetLife here, much higher dividend payer. The annual dividend yield is 4.7%. What does that mean? That means if I buy a share of Met, and I don't care what happens to the stock price up or down, I can expect to make a 4.7% dividend income each year, okay, that I can spend. That means that I don't have to sell the stock, but if I have $1 million, I wouldn't put all my $1 million in one stock, but if I did, I had $1 million, the dividend income would be $47,000 a year, and I can take that out every year and not have to sell my stock, okay? Now, let's boost it. Let's boost this yield with options. So in this case, in Starbucks, we weren't concerned about the earnings announcement. Now, every 3 months, generally, companies announce earnings, and that's when stock prices tend to move a lot. If they exceed expectations of analysts, if they don't meet expectations of analysts, you can have a lot of volatility in the stock price. Some people don't like that, but if you're holding an option through that date, you're going to get more income today. You're going to get more option premium, again, generally. So in this case, I'm going out 3 months to November because the earnings is November 4th, which is the first week of November, and the option here expires the 3rd week in November. So in this example, I can buy 100 shares for $38.88. I can agree to sell the stock within 3 months at $40. I'm going to get I can't read that. I'm going to get $233 of income today. My downside protection is 6%. That means that Met can fall up to 6% and I'm profitable, basically. I mean, again, I am profitable if that stock falls, not much. I mean, that's pretty good. I mean, if the stock stays flat, goes up a little bit, falls 5%, I'm still profitable. Again, if the stock flies up to 50, I still made money, but the lady who bought the stock without selling the call option made more money than me. Okay, but what if MetLife goes down to 30? Guess what? The lady that bought the stock loses more money than me, the lady that bought the stock and sold the call option, because I got that call option income she didn't get. Okay, so this probably made some sense to you, or you're totally lost, or you totally get it. Doesn't matter. You can review this presentation again. You know, everyone learns at their own pace. Do not feel bad if you're not getting it. And if you're, you know, if you're a person who's getting it, you're probably pretty excited right now, as was I when that light bulb went off on my head. Okay, let's keep moving. All right, now another strategy I love. Now, of course, back up. Covered calls, you need a lot. I mean, you know, there's a lot of advanced things about it. I just gave you a quick, you know, overview, but it takes a lot of time and experience to get really good at it. Now, another strategy I love is getting paid to wait to buy stocks on sale. Think about this. I get paid to wait to buy stock on sale. So let's use this example with shoes. I'm getting paid to wait to buy the shoes on sale. Okay, look at these black sandals. I bet you already have a pair of black shoes in your closet. I don't know if they're high heels, they're sandals, they're pumps, whatever. But you're going shopping at Macy's. And I don't know if you have a Macy's near you, but you probably have a department store that's like Macy's anyway. Would you pay $200 to buy shoes at Macy's now when you can come back a month from now and potentially buy them on sale for 10% off? I can tell you Macy's, and let me tell you, they're always having sales. So if I see these cute sandals that I'd like to buy at $200, I bet you they're going to be marked down a month from now. Maybe not, but probably. And maybe they're going to be marked down 10% or more. And then I'd only have to pay $180. And I don't really need those shoes right now today, do I, ladies? No, I already have black shoes. Okay, so that sounds good, right? You just come back, buy it on sale, maybe if it's on sale. But get this, light bulb. What if Macy's gave you cash credit today, or even $5, just gave you cash, if you committed to come back in a month and buy the shoes at an agreed upon sales price? Okay, the shoes are $200 today. Macy's says, Laurie, listen, Laurie, I'm going to give you $5 now, and it's yours to keep. It is absolutely yours to keep, no strings, if you come back a month from now. And if you come back a month from now, if the shoes are marked down to $180 or less, you have to buy them for $180. Okay, so if they're marked down $180, I got to pay $180. But if they're marked down to $170, I still have to pay $180. But that's okay, because I was ready to buy them for $200 today. So no loss there. And if they haven't fallen to at least $180 or less, get this, I don't have to buy the shoes. And get this, I keep the $5. I gave the $5. That was put option premium Macy's paid me. Put option premium. I get paid now, and that money that I got paid is guaranteed. It's not a lot of money, but it's money. And if I can do this every month or every 3 months, hey, they pay me now to agree to buy the stock at a lower price in the future. If the stock hasn't fallen low enough to hit that price, I do not have to buy it. If it falls to that price or lower, I have to buy it at that price. Well, I love this strategy. It's called selling a cash secured put option, or selling a put option. I mean, I love buying things on sale. So why not buy stock on sale, right? I mean, if I like these shoes at $200, I'd be thrilled to get them at $180. If I like the stock at $200, why wouldn't I be thrilled to get it at $180? Now, here's the downside. The stock could fall to $150 and I got to pay $180 for it. But get this, I was going to buy the shoes for $200. I was going to buy the stock for $200. If I laid out $200, did an outlay of $200, or 100 shares, $20,000, and they fall to $150, that stock falls to $150, I've taken a a $50 loss per share, right? If it's $200 per share and it falls to 150, I've taken a $50 loss. But if I sell the put option, I got $5. In my scenario, $5. The put option could be higher or lower. And I have to pay 180 for them, but they're trading at 150. But see, I have to pay 180 plus I got the $5, whereas the other lady who bought the shoes or bought the stock is now down $50. I'm down less than she is. I'm always going to be down less than she is. So selling a put option is less risky than buying the stock today. And why not get paid to wait to buy the stock in the future? All right. And it might be a month from now, it might be 3 months from now, depending on your option expiration. Again, what's the downside? I'm still going to lose money if the stock goes down, but only if the stock has gone down significantly, and I'm still better off than the lady that just bought the stock. Okay, now once again, why not just buy the stock? If I'm so bullish that I think the stock is going to skyrocket, I don't want to sell a put option because then I'm missing out on all those gains. When you sell a put option, you're really doing it to generate that option premium. Okay, again, this might take a while to sink in. Okay, selling a put option, which is the shoe example, is less risky than buying stock. This is what I've already said. I'm going to summarize it. You get paid premium income, option premium income now for the obligation to buy stock at a lower price in the future versus buying the stock at the current market value today. Okay. This is an ideal strategy for using up capital loss carry forwards. If you don't know what that is, let me explain. I have a client right now, divorced. She and her husband, they invested, they had losses on real estate. They had losses on stocks over the years. And if you can't, you may know that you can deduct only a small amount of losses towards your income, or you can reduce your taxable income only by a little bit if you have these capital loss carry forwards. So you need gains to use them up. They're short and long-term losses. And I don't want to go into a whole tax thing about that. But the point is, she has hundreds of thousands of these losses that she can take. She needs gains. I can sell put options all day long and never generate taxable income for her. Normally, selling a put option in a taxable account is taxed at ordinary income rates or short-term capital gains rates. But she has so many losses that she's carrying that I don't even know when we'll ever use them up. I mean, she's already over 60. So can you imagine what a great sales point this is versus another financial advisor, when I can say to somebody, I can generate you tax-free income. I can use up those capital loss carry forwards for you for years, right? Depending on how much you have. That's so empowering. And if this is in an IRA, you don't care about the taxability of options, whether it's short-term capital gains or not, because in the IRA, you're not paying taxes every year on that investment income. You only pay taxes on the income you withdraw, usually in retirement. Okay, I've got to check my clock. I'm running out of time, I think. Okay, we're going to wrap up soon. So, look, if you like the strategies of covered calls and short puts, there's two ways you can approach this. You can have it done for you, or you can do it yourself. So if you want to have it done for you, you have to find a wealth manager or a financial advisor with expertise in options. Very few of us financial advisors, there's financial advisors on every corner, but very few of us have this expertise. And those that do, very few of those use it with clients because it's so time consuming, right? And we've got, fee competition. I've got financial advisors that are going to put you in ETFs or mutual funds and charge 1% a year. Well, on options work, I may charge between 1 and 1.5% because it's so time consuming. The way we do it at Coastwise Capital Group is we typically save option strategies for accounts, combined accounts of at least $500,000. That's our asset minimum for options work, again, because it is so time consuming and it requires a lot of skill. All right. But you may not if you're not interested in this strategy, you can find a wealth manager that will put you in individual stocks or funds or what have you. Now, if you want to do it yourself, it's easy to set up. You request options authority with your online broker. You can do, these two strategies are conservative, so you can do them in an IRA. You can't do some of the speculative strategies in an IRA, and for good reason, because it's your retirement money. So you can do this in a taxable account or an IRA. And I usually say, if you're going to start, try to start with about $50,000, because you want to be diversified. If a stock on average trades at $50 a share and you have a $50,000 account, you can have 10 different positions, sell covered calls on 10 stocks. You can use less money, but then you're going to have to use some ETFs, and you could probably start with 30,000, certainly if you're just learning. And then you really need training. Now, at my firm at Wize Capital Group, myself and my colleague Scott, we do one-on-one training via Zoom, but really just a small number of people that we can handle per month. So it's not our main thing to do, but we do it. We just don't do a lot in a month. Okay. So, and if you don't want to work with us, that's fine. There's tons of online classes that you can take and training programs, tons of resources on covered calls and short puts, other books. I'm not the only one that's written a book on this. So anyway, that's the deal on that. And let's see, I'm trying to get okay, so just let's wrap up here. There we go. So I'm saying here to get in touch for special offers. So I've created a landing page at my website, The Options Lady, theoptionslady.com. I've made a special landing page, Wize Women Expo, and that has some special offers for you, also resources. I provide more information about Born to Sell, the platform I showed you. I always encourage everybody, sign up for my free newsletter. I send it generally once a month, not too much, and people seem to like it. I have a very low opt-out rate. So anyway, this has just been, I'm just so delighted. I was given the opportunity to present on my two favorite strategies when investing in the stock market, and I hope you can share my passion. I hope you're intrigued, and I just, again, get in touch with me. The best way to get in touch with me is through my website. I've also provided my email address, Laurie at theoptionslady.com, and my phone number. And again, want to thank Wize Women Expo and all the other speakers and everybody who's attended during these 2 days and everybody who's watching the replays. So good luck to you. Have fun, and thank you so much for participating. Again, this is Laurie Itkin, the Options Lady.
Okay. How are you ladies doing? Can you hear me okay?
Yep, we can hear you.
Yeah, we hear you.
We have Sarah, we have Ariana, hi, all my beautiful ladies, Chris and Maisie. So those of you who work with me know that the exact strategy that Laurie showed is what I teach. What were some of your big takeaways after watching her presentation?
That she's super smart.
Yeah, well, and you could be as smart as her.
Exactly.
Learning this. So this is what I know inside and out. This is what I've been employing, in my own accounts. And I've been passionate around helping women to create income, to turn up the rate of return in their long-term portfolio so they can live life on their terms. So just a little wrap up. Just Sarah checking in with you, and Maisie, anything you want to add?
I like this Macy strategy that she used, because that
Yeah,
really, I was like, oh, okay, all right, now I understand it a little bit better. So, yeah.
Yeah, so together you can put your list of companies that you believe in and that you love. Like for instance, Brit loves dogs, as you can see in her picture there. So she might look at Chewy, right? Starbucks, if you go to Starbucks and you could say, wow, you know, Apple at the split was 129. At that point, you could have said, you know, usually after a stock goes up, it comes down a little bit. I'd be willing to buy Apple at 110 instead of 129. You could have sold that put at 110. And instead of paying $129 a share like most people did right after the split, you would have had the opportunity to only pay 110. So that's an awesome strategy. Maisie, I know you and I had our call together today. So what we went through, hopefully all of that came together for you in a bigger way.
Yeah, it did. And, you know, it just really points out to me how when it comes to your money, you really need to understand what things are going on, because, you know, I think her point of if you're owning a stock, you probably do want to do some, you know, covered calls or short puts because you're already owning the stock. So you want to kind of hedge your bet. I mean, there's no sense in being super greedy, because I think that's what happens to people. They become super greedy, and then with the super greedy comes the volatility. Like if you're just doing other options that are so risky, that's because you're so greedy. You want a big hit. But, you know, slow and steady wins the race, as far as I'm concerned. At this point in my life, slow and steady, as long as I can do what I want to do. And I don't have to have $1 million tomorrow per se, but if I can have enough money that every day I feel like I'm a millionaire, that works for me.
Wonderful. Yeah. And this is the way to create predictable income, predictable growth, because yes, the dividends there, but you all saw how the covered call is so much more than the dividend. And if I'm okay with making 10% a month, by the way, that's a lot if a stock moves 10%. If I'm okay with that, and if the stock goes up more than 10%, I'm fine, because I have that premium with the covered call. I just went up, and if I love that stock, I'll buy it again. If not, I'll reinvest my money in, you know, in something else that I believe in that will be a steady, great investment for me. So we're going to do a group class on this starting mid-October. And I know all of you here are working with me one-on-one to understand this. Every single Wednesday, I do a free session at noon Eastern at this very place, dawnwebinar.com. And every single Wednesday, I go through stocks that you want to look at and how you can turn them into income generating vehicles for yourself. So I show you what the stock is priced at, what the covered calls look like. These are ideas. I'm not a licensed financial advisor, so I'm not, you know, encouraging you to learn how to fish so you can eat for life. So mark that down on your calendar. And I'm going to also create a calendar. I'm going to create a little link that once you click on it, all of these events come on your calendar. So not only are you working with me one-on-one, we're meeting for free every single Wednesday. And from time to time, people want to do this DIY. And I will work with you once you learn all of this, you know, to meet up with you every week and just see where everything is going in your account. And I call that my 30 minutes to millions just maintenance program with all of this. And certainly you could hire somebody like Laurie, and I am, you know, Laurie and I are partners in prosperity. So if I'm actually going to have her do a private session for all of us in a couple of weeks. So you get to meet her in a private group of just us chickens. So how do you like that?
Good. Good.
Okay.
Love it.
Awesome. Say yes if you're excited about
Yes.
increasing your income potential, right? And cash flow.
Yep. I feel the money. I feel the money.
Yes. Okay, have a great rest of the day. Bye now.
Thank you. Thank you.
Bye.
Bye.
Thank you.
Thanks all.